The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. We're back again. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I'm going to begin, as I always do, by saying thank you. Number one, thank you for taking the time to watch or listen today. But above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough, but you're always going to hear it here. The other person you will always hear here is my buddy, guru, Ed Zerndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. So if you're new to us, one of the things we do is we follow some of Ed's FedZone articles, which are dynamite, which you can find at fed-zone.com. And this gives us an opportunity to amplify it, present it a little different way for our auditory people or our visual people. So today, we're talking about a situation that I think has a risk of catching more federal employees off guard than perhaps at any time before. And that has to do with excess contributions to TSP. Well, Dan, how would that happen? Okay, well, we had folks leave federal service, in some cases involuntarily, last year. And hopefully, God willing, they got another job. So they might have been contributing to two plans. And if they ended up putting more than they should have in total, then that can be a problem. So Ed's written another great article, laid out exactly what happens, what the deadlines are, and what, unfortunately, the tax consequences are if you don't handle it correctly. So Ed, let's start with the basics. IRS sets limits to what employees can contribute. So what are those?
As you said, Dan, the IRS sets limits every year on what one can contribute to their qualified retirement plan. What's an example of a qualified retirement plan? A 401k plan, 403b plan, 457 plan. The TSP is not technically a qualified retirement plan, but it follows many of the benefits of a qualified retirement plan. And one of which is that the contributions you make to the traditional TSP are tax deductible. Tax deductible, meaning that contributions you make reduce your current year taxes. When you contribute to the Roth TSP, you don't get any tax benefits by contributing to it. The tax benefits come when you take the money out of the Roth TSP. It's called a qualified, it's when you don't pay any taxes. You know, IRS, as I said, sets the limits. And I've gotten this question all the time from clients. And the question is, I don't understand something. Maybe you can help me, Ed. I said, what's that? You know, here the government is encouraging people to save for retirement. They want you to put money away. You know, they're making it easy to let, you have your contributions come from your paycheck. Why do they set a limit every year, of what you can put into it? Why does the IRS come out with this announcement like for 2026? The announcement came out in November. It's usually in November, what the limits are going to be for 2026. And the reason is that when Congress does something to reduce the deficit, they have to have it, to allow you to, in this case, it does not reduce the deficit, probably is going to increase the deficit by allowing one to deduct their contribution to their qualified retirement plan. On the one hand, they're giving something. On the other hand, they're going to take something away. They're going to take something away, just to make up for that. So it's an equalizer. So they want to put a limit. They want to put a limit each year how much you could put away as far as reducing your current year tax liability, or in the case of the Roth TSP, what you're going to be paying down the line. So
Gotcha.
that's why they set a limit. So the limit for 2025, the limits were, and we're going to break it up, it's called elective deferrals. Elective deferrals. The limit was, I should say, because it's 2025, $23,500 that an employee could contribute to the traditional TSP, to the Roth TSP, or a combination of both. They could put, let's say, $250 into the traditional TSP, $12,250 into Roth TSP. That's the max. That's called a maximum amount for elective deferrals. Then we have the catch-up contributions. If you're going to be, those employees who are at least age 50 as of December 31st, 2025, could put in an extra $7,500 in addition to the $23,500. That's a total of $31,000. And there's something called the super catch-up. If you were 60, 61, 62, or 63 during 2025, you could put an extra $3,250 catch-up contributions. That makes a maximum of $10,250 added to the $3,500 for a maximum of $34,750. That's the maximum. So those were the limits during 2025 if you were a federal employee. Now, as you said, 2025 was not a good year for Feds.
Absolutely.
Early retirements. Some employees were almost forced to retire. There was maybe a VERA or a VSIP, a discontinued retirement. Some employees were RIFed. They took deferred retirement. They left federal service in the middle of the year. So the question comes up. Let's suppose these employees who retired early, left early, hopefully got other jobs. But before they left federal service, they heard the preacher, take full advantage of the TSP before you leave, because when you leave federal service, you can no longer contribute directly to the TSP. So take full advantage of it. And a few employees I talked to said, yeah, they'll do that. They want to take advantage of it. And they did. So the question comes up, when they got their new job, their new employer offered a 401k plan. The question is, can they then when they start working, this is the middle of the year, can they contribute to the 401k plan? Putting money into maybe a traditional 401k, Roth 401k, can they do the same thing?
Sure.
And many of these employers offered matching, sometimes good matching, maybe more than the TSP, 6 to 10% matching contributions. Oh, that sounds good, right? Free money, Dan.
Absolutely. We love it. Now, Ed, you go a step further, as you always do, and you gave us an example of Jerome in your article. Take us through what happened there.
Okay, so I'm going to read the example here. You have Jerome, age 58, Dan. He retired from federal service on September 30th, 2025. Between January 1st, 2025 and September 30th, Jerome contributed the maximum $31,000 to the TSP. That is $23,500 elective deferrals plus another $7,500 catch-up contributions. He put $20,000 into his traditional TSP and $11,000 into the Roth TSP. That's a total of $31,000. And he got full matching. He's a first employee, full matching, and that is the maximum match of 4% plus a 1% automatic 1% of his SF50 salary contribution. It all went into his traditional TSP account. On October 1st, 2025, Jerome, he didn't waste any time. He immediately started a new job. He got a job in private industry in which he participated. He contributed $10,000 to his private company 401k plan between October 1st and December 31st. So he put $31,000 into the TSP and $10,000 into the private company retirement plan, 401k plan. So that's a total of $41,000. What was his limit? For the year, $31,000. that makes an excess contribution of $10,000. So now what? What's going to happen now? He made a $10,000 excess contribution. Does Jerome have a problem here?
I think he does. I think
Yeah.
he does. And I know further in this, you're going to give people solutions. But a question just popped in my mind, Ed, so I want to ask it. What about our federal employees who are members of the Uniformed Services Ready Reserve? They might have both a civilian TSP and a uniform TSP. How does that work in case they inadvertently might go over?
Well, I have good news because
We like good news.
the TSP checks in January. This is last month in January 2026. The employee got a W-2 statement from their civilian agency, and they got a W-2 statement from the Defense Finance Office. On those W-2 statements, it shows the amount of contributions going to the TSP. The TSP also has records, and the TSP will add up all the numbers. And they will know that when you add the contributions in total to the civilian TSP and the raw TSP, that the TSP will automatically reduce the total contributions. The way they do this is they first take the money out of the uniform services, That comes first until it comes down. And then the earnings are taken out pro rata. So there's no problem. There is no problem when it comes to if you are a federal employee who contributes both to the civilian TSP when they're working, and then when they go on active duty, they're in the Ready Reserve, they start putting money into the Uniform Services TSP account, and there's no problem. Now, there's one exception, though. One exception to the contributions to the Uniform Services account. Let's suppose we have an employee who is called up on active duty and has to go into a combat zone. Any compensation that a uniformed service member earns while serving in a combat zone is not taxable. It's not taxable. And if that uniformed services member takes part of that tax-free compensation and puts it into the traditional TSP, that will not be included in the compensation of excess contributions.
Gotcha.
Just want to make it clear.
So those are helpful clarifications. Now, let's go back to our friend Jerome, who contributed to the TSP and then into a completely separate employer's 401k plan. How do they even know, meaning Jerome, that he's got an excess contribution?
Well, here comes some bad news. It might be I think people are going to be disappointed. The TSP service office and private employers' payroll offices do not communicate. First of all, they can't. I mean, they're looking at private information here.
Sure.
So whose responsibility is it to make sure that there are no excess contributions when you combine the plans?
I'm guessing the employee.
In this case, Jerome. Jerome has responsibility to know he made excess contributions. In the example here, he made excess contributions during 2025 of $10,000. The question is, well, how is he going to know that? There's a form out there. There's a form for everything, Dan.
There always is.
Here, it's not a form. It's a W-2 statement, a W-2 form. Everybody gets a W form. If you were working during the year, whether you work for the federal government, you work in private industry, you earn money, you get on the W-2 statement is reported your taxable wages, Social Security wages, taxes withheld, state wages, state income taxes withheld, and there's a whole bunch of boxes on there. Let's go to the two important boxes that everybody should take a look at for your 2026. And those boxes are, I got to make sure I got the right box and codes. I always have to review this. Yes. Box. So box 12D on your W-2 statement. Okay. It shows the total amount of elective deferrals and catch-up contributions to the traditional TSP. In the case of Jerome, when he worked in private industry, he put the $10,000, let's say, into the traditional 401k. It would be in box 12D of his W-2 from the private employer. Box 12 AA, okay, AA, shows the total amount of elective deferrals and catch-up contributions made to the Roth TSP. Remember, you have to add the two together, okay, to come up with the amount. So in Jerome's case, when he gets his W-2 statements, first from the federal government, second from finance, he has to go to box 12, 12D and 12A and add the numbers together to see how much excess contributions are. So at that point, he says, oh, I have an excess contribution of $10,000. Now what? What do I need to do?
Well, again, Ed, great segue. What's the process of fixing this once you discover?
Jerome's a choice. He can either contact his private employer payroll office to take out the $10,000. This way, he'll be at the $31,000 level, or he could contact the TSP and do the same thing, have $10,000 taken out of the TSP. Now, here are some of the issues in terms of which one he should do. Remember, Jerome is a FERS employee. He got matching. He got an automatic 1% of gross pay of his SF50 salary contribution. He got a 4% maximum match because he contributed at least 5%. If he sells the TSP, take out the $10,000, he would lose that 1% on that 1% contribution from his agency, 1% of the $10,000, which is $100, plus the 4% matching, as well as all the earnings on that. Should he do that? Well, what did his private employer give him in terms of his $10,000 contribution? I found out he got an 8% match. Maybe he should tell the TSP, take the money out, because he got more out of that $10,000 that he contributed to private employer 401k plan, the matching. So that's an issue.
Gotcha. So if they decide they're going to go back to TSP,
yeah,
what's the procedure there? What do they need to do?
Yeah, and the procedure is the employee has to go to their account, my account. It's called My Account on the website there, and then fill out a form. It's called Form TSP-44. Again, you have to have an online account just to get this form. And that Form TSP-44 is entitled Refund Request Form. This form, by the way, TSP-44 is put up every January. They put it up as of close to January 1st, and they take it down on March 15th. In the right-hand corner of that form will be the year that it applies to. So if Jerome, let's say sometime last month, downloaded that form, in the right-hand corner will be 2025 because it applies to 2025. So Jerome would fill out that form telling the TSP that he wants $10,000 refunded, taken out, and he has to complete the form and submit it by March 15th, 2026, because if he doesn't, the TSP is not going to do anything. It has to be received by March 15th, 2026. That's the deadline.
Gotcha. So now he's done that. Let's talk about the tax consequences. So how are these excess contributions going to be treated?
Okay. All right. So first of all, remember I mentioned that when Jerome contributed to the TSP during 2025, $20,000 went to the traditional TSP and $11,000, I believe, went to the Roth TSP. He can tell the TSP which account to take it out of, which one, either traditional or Roth. Okay. Either way, any matching contributions, the 1% of agency, 1% of $10,000, 1% of this $10,000, $20 will be also given back to the agency, and the matching contribution will also given back to the agency. So the tax, if he says, I like it to be taken out all from the traditional TSP, then the TSP will take the $10,000 to $10,000, the contributions will be added back to his wages for 2025, which means that Jerome is going to have to wait till he gets an amended W-2 statement, okay, before he can do his taxes. Remember, on his original W-2 statement, which he received in January, it showed, $10,000 either going to the traditional TSP or raw TSP or both, but it all went to the traditional TSP. His taxable wages were reduced by $10,000.
Sure.
That the TSP now has to add back that $10,000 to the wages. So his W-2 is going to be amended. It's called a W-2C, corrected. So he cannot do his taxes. He cannot do his taxes until he gets that W-2C.
Sure.
That's why you should do this right away. Don't wait till March 13th to submit the form, because it may take the TSP a little while to get in. You don't want to get too close to the April 15th deadline to do your taxes. Now, what about the earnings? The earnings on that $10,000. The TSP will calculate what were the earnings that were generated from that $10,000 contribution to the traditional TSP during the years. How much did he get in earnings? Those earnings will be refunded to Jerome this year. It's going to be income, interest, dividends, no 10% early withdrawal penalty. It's just going to be added to his income for 2026. He'll get a statement that he got this much in income, and he'll add that to his 2026 when he does his 2026 taxes. And if he put the money into the Roth TSP and that money has to be put back, there are no tax consequences, because remember, the Roth TSP contributions are made with after-tax dollars. It doesn't affect his salary, so he will not get a corrected W-2 statement, And then again, the earnings that were generated with any Roth TSP contributions will be distributed in 2026, and he has to pay tax on, even though it went into the Roth TSP.
Gotcha.
Qualified distribution, again, with no 10% on withdrawal penalty.
So that's important to note. So Ed, I almost hate to ask this question, but what happens if somebody misses the April 15th deadline?
I was afraid you were going to ask that.
Yeah, I know. I'm sorry, brother. Had to do it.
Okay. Well, here's what's going to happen. Remember, after April 15th, the employee cannot request to have any type of 2025 excess contributions refunded. It's too late. They cannot do it. It's after April 15th. Okay. The excess deferrals will remain in the employee's TSP account. As such, with a traditional TSP account is distributed in the future, then the employee will be taxed twice on the distribution.
Oh, ouch.
The first time is because he didn't put the money back when he was supposed to. Okay, Jerome. The second point is they're getting income now. They have to pay tax twice on the same income. Dan, I hate paying tax one time.
Yes.
They're paying tax twice. Oh, it hurts. And there's no reason for that. So beware. Okay.
Absolutely,
and the Roth
folks.
TSP, guess what? The Roth TSP, if the money went to Roth TSP, you'll pay tax. You'll pay tax on the contributions coming out, even though you're not supposed to. It was made with after-tax dollars. So that's double taxation again.
Oof. Now, any early withdrawal penalties tacked onto this? Hopefully, no.
Actually, not, because, when it comes to the Roth TSP, there might not early withdrawal. No, if it's before 59 and a half, I was thinking 459 and a half. In case of the Roth TSP.
Okay, gotcha.
Not a good thing to do. Not a good thing to do.
Absolutely. But I'll tell you, I'm really glad you wrote this article, because I think this is something I can see happening
Especially like last year, I should say. All those people
2025. Yeah. If somebody was in federal service, and I know this happened a bunch, and they got a job in academia. Academia has some huge matches that they make available. So I can understand where somebody would say, oh, wow, I want to get as much in here as I possibly can before the end of the year. Let me go right up to the maximum on it. And then come to find out they've created a problem for themselves. So thank you. I always thank you, brother. But
Dan, I
this
just want
time
to
it's
mention that I have it on my calendar that I write. I like to write this column every January.
Yep.
It's always relevant. I just say it's a great article because timing is so important here.
Sure.
And again, to repeat, if you think you were in this position where you made excess contributions to the TSP and to another plan, I'm not, in private industry, by all means, look at your W-2s. You got to do it. Don't wait till early March when you give your W-2s to your accountant and have your taxes done. It's getting too late. Do it now. And if you made those extra contributions, go onto your TSP account online, download that Form TSP-44. If you have to talk to a financial advisor, I know at the Serving Those Who Serve, and your advisor, you advise federal employees. I'm sure you're well versed in this Form TSP-44, and
absolutely,
and do it now. Do it now.
Absolutely, folks. Do not miss that April 15th date. So again, Brother Ed, thanks for bringing this one to the front. I know you do it every year. This year, I think it's going to have even more impact. So folks, if you're watching this, you go, this doesn't apply to me, but I wonder, share this with your friends because you could head off a real problem for it. So folks, that is a wrap. We are Serving Those Who Serve. So be sure to subscribe to this podcast on YouTube and please, please, please share it with your friends and even a few strangers. Don't forget our live webinars every single week, pretty much. Just head over to the scwserve.com. You'll see the webinar button. Click it. You'll get the whole menu. Pick out the ones you like. Yes, the guru will come to you to reach, teach, and serve you right where you are. Sign up for one, sign up for all, share with friends. I promise you they'll thank you. And if you don't have this as a habit, make it one. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I'm going to sign off as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. So make it a great one because you absolutely positively deserve it. Stay well, everybody. We are out.